Hello, hello, hello. Welcome to Stock Trades. Now, this is going to be an emergency video, very important video to go ahead and discuss. This is in response to SVB Bank, Silicon Valley Bank. Recently, a lot of things has happened to this bank. If you haven't realized, it was just recently closed by the regulators regarding a possible bank run that could happen on the company. Now, a lot of VC startup companies were able to just withdraw some of their money. However, there's been others that have not. Now, why am I making this video in relationship to Clover Health? Well, the reason being is you have to understand this bank is most likely has a high probability of including many VCs and startups. And also, Clover Health is a startup. Now, we haven't heard any company issuance or formal newsletter that suggests that Clover Health has their money inside of this company. However, I wanted to bring it to your attention because if you look at the All In Podcast, episode 119, Silicon Valley Bank implodes, startup extinction event, contagion risk, and so on and so forth. There's a section in which Chamath Palihapitiya talks about how first he wants to apologize for all the people that are basically dealing with this contagion and all of the startup companies that have to basically navigate this storm. He goes ahead and he specifically states that he has on his own portfolio of social capital, he has some companies that are affected by the Silicon Valley Bank imploding. So there is an effect in Chamath Palihapitiya's portfolio. The problem is he does not discuss exactly what part of the, what company it is. It could be anything. But I wanted to bring it to your radar that it may, as of right now, we're speculating, but there's a reasonable doubt that perhaps maybe Clover has their money in there. Now, you may ask yourself, well, Al, it's a bank. Why is this bad? What's going on here? Well, for most folks, there's something called FDIC insurance, and it can essentially, it's an insurance that was created, I believe, back in the 20s and 30s to protect consumers that have a limit of $250,000. Anything above that, the insurance is not covered. So a lot of retail investors and some folks in our stock terminal, they go ahead and they have multiple brokers and dealers to basically parcelate and separate their six-figure plus income in different areas so they can qualify for this FDIC insurance. The issue is if you're a company, and in Clover's case, has approximately $500 million, you cannot physically do business by separating your accounts by $250,000. You're going to have multiple banks. I mean, think about it. 500, let's see here. 1, 2, 3, 1, 2, 3, 1, 1. Divide by 250,000. They would have to separate their accounts and create 2,000 accounts. So obviously, there's a probability that maybe Clover has their money in there. So I recommend emailing the investor relationship page, and management should basically clearly define, as this is a Silicon Valley problem. It's equivalent to a 2008 great financial crisis for tech stocks, especially for startup companies. It's definitely highly advantageous that management in Clover communicate to investors that they are not affected. And if so, if they are affected, what are the plans they are going to take to basically get them out of this funk? This is a big deal because if they don't have access to their funds right now, because what's going to happen is they're going to have to sell the bonds that SVB basically bought in order to satisfy the cash requirements for these startups. The issue is they're not going to be able to pay bills. They're not going to be able to pay their employees. So essentially, there's a big problem. Now, some of you guys may be scratching your heads right now and say, Al, what's going on with SVB Bank? You didn't really tell us why it's imploding. Okay. So what happened is, and this is a great diagram that the All In podcast generated. I went to the source from our brain machine. If we can go ahead and zoom in to the balance sheet of SVB Bank, you can see that if you go ahead and take a look at total assets, they have $211 billion. Now, I know All In Podcast has a different number, but relatively we have the same liabilities, which I don't understand how they get the 208. But in this regards, we have $211 billion in assets and $195 billion in liabilities, which just leaves us a difference of $16 billion. Now, if you go ahead and compound and do a quantitative current ratio by taking essentially the total assets divided by the total liabilities, you get a current ratio of 1.08, which means that they're neck and neck with being able to satisfy their liabilities. This is very dangerous, especially for a bank. Now, just out of curiosity, we can go ahead and take a look at the financials. Let's say JP Chase stock. What's the ticker symbol here? See, JPM. And out of curiosity, we can just go ahead and type in JPM. Let's go ahead and download this. And just to see kind of what would be the current ratio for JP Morgan. So if we go ahead, go to the balance sheet here, zoom in, total assets, they got about here, and then total liabilities. So they have a lot more wiggle room. So if you go ahead and take the difference between their total assets, and this is JP Morgan Chase, between their total liabilities, they got around $292 billion of differences versus SVB Bank with only a $16 billion difference. So 292 what Chase had. Now, if you take what Chase had and divide it by what SVB's differences in assets, well, I can't. Let me go ahead and do this and say type in 16. Go ahead here. Chase is 18 times more liquid than Silicon Valley Bank. Just to give you kind of an example here, right? To go a little deeper between JP Morgan, which is kind of the star bank, where you can go ahead and look at Bank of America. You can see how problematic the debt to equity ratio is for SVB. Now, what's interesting here, back in 2020, 2021, they went ahead and they took all this cash and they essentially purchased bonds. They purchased a 10-year treasury, which was equivalent to a 1% to 2% return on investment. And what they did is they pretty much bet against the fact that the Federal Reserve is going to continue raising interest rates. They bet on the fact that they did not believe interest rates were going to go high. They did not believe that cash burn is going to be essentially the most stringent thing most folks are going to look at. They essentially gambled and they did a miscalculative risk by taking in, billions of dollars and locking them up with the government to pay 2% back, when in reality, if you were to do this now, you can make 4%. And based off of the most recent Federal Reserve remarks, possibly even 6%. In fact, if you look at a 30-year fixed mortgage, it's 6% now, and there's no doubt in my mind it could go up to 7 to 8%. So what does this tell me? This tells me is that this bank and many other startup companies did not believe that money was being dried up. Many of these startup companies most likely did not believe that perhaps 20 years are going to essentially not happen for quite some time, maybe 10 to 15 years from now. So what's interesting here now is the biggest part is, when can the people that have deposited their hard-earned worked money in this bank to allow them to pay off their employees, essentially, when are they going to be able to take this money out? And the second question is Clover Health affected with this contagion? So definitely send your emails, messages, or what have you to the board. Request for them to essentially create a formal letter to basically document to shareholders that they are not affected. Now, I assume this is going to already be on their list, but many other companies are drafting these letters up right now, and we are going to see how the ball moves on Monday. So there's that section. In the next upcoming videos, we're going to do an intrinsic value calculation with a decreased revenue percentage and a possible increase in the outstanding shares as requested by our beautiful colleagues on our stock terminal and mastering stock market course. We're going to go ahead and do that, and just stay tuned. But I wanted to bring this video to you guys quickly. We're going to go ahead and go to the quick comments here, and then I'll sign out. Well, doesn't have their money in there. Absolutely. Yeah. It's just another issue they have to deal with that wasn't even their fault from the beginning. If Clove puts out a statement that they are not exposed, that would be the most bullish news. Yeah, absolutely. Absolutely. So this is why I'm making the video. Hopefully they maybe you can link it to them. But overall, this is kind of what's going on right now. Now, I recommend you please watch this video. In fact, here, I'll put the link I'll put the link in the chat here. Definitely watch this video. And I wanted to basically, as soon as I heard Chamath say he had some companies in his own social capital portfolio that is directly exposed to Silicon Valley Bank, I had to tell you guys immediately. All right, guys, I'll see you on the next one. And stay safe.